The intent of your remittance, it will be clear to even to the banker. At the point of receipt of money, the seller or the licensor will mark it up by the required percentage. Every month, on the 7th of every month, we have an average collection of 75,000 crores of TDS into our kitty.
This is Adhitya, Srinivasan, and this is the Private Office Podcast. There's been a lot of chatter in the recent days about the new and higher TCS on transactions under the Liberalised Remittance scheme. What is TCS? What is the LRS? What is all the fuss about? We'll find all of that out today. I'm joined by the former chairman of the Central Board of Direct Taxes, Mr. Mohapatra. Sir, thank you so much for joining us.
Good to be back.
So let's dive right into the issue. Let's begin with the basics and try and set up a conceptual framework so that our listeners and viewers can understand what the issue is all about. So what is TCS?
There are only 4 ways in which you can pay taxes. TCS is one form of paying taxes. Tax liability can be discharged by way of payment of advance tax, number 1. Number 2 is self-assessment tax. Number 3 is the regular tax. When there is a tax demand, you can pay by way of regular tax demand.
In response to the demand.
In response to the notice and the order. Yeah. And the 4th one on which you are discussing today will be the TDS and TCS. Right. TCS is the tax collection at source. As against the TDS, tax collection at source, it has a different meaning, different approach, and different sectors are affected by TCS. As we go into the various ramifications of TCS and how it is applied, we will learn about the methodology and the logic and the philosophy behind why TCS has come into being.
So let's just go from that point. Why is it that the Parliament has devised this mechanism of TCS? What is the need to have a TCS system for collection of taxes?
Right. So, TCS cannot be read and understood in isolation. It has to be read in conjunction with TDS.
Right.
TDS and TCS, as I told, it is one of the 4 forms of discharging a tax liability. And its importance can be measured by the fact that our major source of collection this year and many previous years would be from TDS alone.
Right.
Giving you the data of this just concluded financial year, out of 16.65 lakh crores of net collections, the collections from TDS alone was 9 lakh crores.
So this is 16.65 lakhs of direct taxes, which has been picked up by the union.
Correct.
Out of which more than 9 lakh crores is on account of TDS and TCS. So that's more than effectively 60% or just short of 60% of all tax collections.
Absolutely.
Direct tax collections are on account of TDS and
Absolutely.
TCS. So I'm interested to know at what point the TDS and TCS mechanisms were introduced into the Income Tax Act. Have they been there from the very inception in 1961, or is it a more recent development?
No, TDS and TCS as a tax collection mechanism has always been there. This is not just true of India, but across jurisdictions where taxation is there will be the TDS and the TCS, because it does the heavy lifting for the Government of India with regard to generation of revenue for Government of India. Every month, on the 7th of every month, we have an average collection of 75,000 crores of TDS into our kitty, right? Whereas the advance tax will be coming in 4 installments by July and September and December and March. We have this TDS flow every month. So TDS importance for the economy, for the periodic injection of money into the economy cannot be underestimated at any cost.
So, and just a short while back, we spoke about how close to 60% of the total direct taxes collections are on account of TDS and TCS. Has this always been the sort of figures that we've experienced? Have they been higher in the past, or have they been lower in the past? And do we see it moving in a northward trajectory in terms of increasing percentages of direct taxes collections coming out of TDS and TCS?
No, TDS as a component of tax collection has always pulled its weight, right? This year it is 60%. Previous years could be in that range or little lower, but TDS, the coverage also, Aditya, it has expanded over a period of time, right? At this point in time, we would have 40 different varieties of TDS and 16 to 17 different varieties of TCS, right? So starting from section 192, where we suffer a TDS on account of payment of salary we receive, right? To 206C, which operates in a different league and different sectors and different environment, and because of different compulsions, we have the TDS and TCS covering many facets of business in which we are engaged in.
Right. And what is the thinking around how and when the parliament or the government decides to impose TCS in respect of a new business activity or a new sector? Are there factors that are considered which would be relevant towards determining whether it's a good idea to introduce TDS or TCS in respect of a particular activity? Or is there anything else that sort of guides Parliament in terms of imposing such a levy?
Right. Before that, let me differentiate the little differences and the logic behind TDS and TCS.
Right.
TDS is when you make a payment to somebody and there is an element of income involved in there, then you deduct a TDS. For example, when you receive your salary and if your salary is above the taxable limits, the employer will deduct tax. When you get a dividend from a company and the dividend payment is more than 5,000 rupees, there is a TDS liability for payment of dividend to you. If there is a contract which is being given and the contract receipts at the time of payment, there will be deduction, right? So for many things, including purchase of immovable property, including payment of professional services, including payment for consultancy services, many areas are covered in the TDS. That is, at the time of payment, you deduct TDS, you deduct tax. At source means don't have to wait for you to file the return. At source is at the moment the payment is being made, the TDS will happen. TCS, on the contrary, is where at the collection point, TCS is being collected, right? The tax collection at source. For example, 206C will begin with alcoholic liquor for human consumption.
Correct.
Forest produce, timber obtained under a forest lease or not under a forest lease, for mining and quarrying, for parking lot, for many of these things, for parking plazas, right? For toll plazas, right? So TCS will be there at the point of collection of money from the buyer. Buyer will come and ask for a particular goods, right? For example, alcoholic liquor. So there will be a markup on that one. So TCS is basically at the point of collection of money from the buyer. The seller has the obligation to deduct or rather collect that markup and give it to the government of India.
Right. So two issues I want to discuss over here. Firstly, am I correct in thinking that in the case of both TDS and TCS, the obligation to deduct or to collect would only apply if there is an active tax liability or obligation for one of the counterparties in the business relationship?
The basic assumption is that whatever money is being paid, whether by way of salary or rent, because the nature of the payment will determine whether there is an element of tax involved, element of income is embedded over there. If a salary is paid out, if a rent is being paid out, if an interest is being paid out, if a dividend is being paid out, if you are purchasing a property, right? So in those situations, there is a fair, consideration that there is an element of income which is passing hands.
Correct.
That is why the TDS and the TCS mechanism kicks in.
So let's talk about the example with alcohol. So you have consumers or purchasers who purchase alcohol from an outlet and they pay for the alcohol that they are purchasing. Now, where is the tax liability in that in this particular example? Is it the seller's tax liability on account of sale of the alcohol for which they are going to collect tax at source from the buyer? Is that what?
The tax collection is, as I told, it's a markup on the sales price.
Right.
So if alcohol is being sold, or a parking lot is being licensed out, or or scrap is being sold, at the point of receipt of money, the seller or the licensor will mark it up by the required percentage, which is stipulated to be paid on that,
Right.
and will be billing the purchaser or the licensee the total amount. And after the collection TCS is received, there is also a mandate that those are to be made over to the government within 7 days,
Correct.
or immediately. But on the seventh day, there has to be statement, etc.
Right. And the way it works is in the form of a markup. So you have a buyer who purchases goods, let's say of 100 rupees, and for the sake of an example, let's assume the TCS rate is 5%.
Correct.
So the buyer will in effect be remitting funds of 105 rupees, out of which 100 is what the consideration that the seller gets on
Correct.
account of the sale, but 5 rupees is what the seller has to make over to the government.
Absolutely.
And it has to do so within a prescribed period of time, and it has to file some sort of form to ensure that all of this is being done properly and that all of the parties to the business relationship are being held to account.
Absolutely right. Absolutely.
Right. Let's now talk a little bit about the liberalized remittance scheme. Can you tell us a little bit about what that is?
Yeah, liberalized remittance scheme, or commonly known as the LRS. This is not part of the Foreign Exchange Management Act 99, and it is not even part of the rules also. But there is a reference to the liberalized remittance scheme, the LRS, in the Foreign Exchange Management Current Account Transaction Rules of 2000, and which has been amended in 2015.
Correct.
In paragraph 3 of Schedule 3 of the Foreign Exchange Management Current Account Transaction Rules, there is a reference that the procedure of remittance under these rules, it will be as per the LRS with regard to Schedule 3. The Schedule 3 items,
Right.
which are listed out in the Foreign Exchange Management Current Account Transaction Rules, they will be governed in terms of the LRS.
Right.
LRS came into being in 2004. It has been told that before 2004, we never had very comfortable foreign exchange reserves. Foreign exchange reserves is extremely important for the primary reason that they are being used basically for our import obligations. So foreign exchange accumulation by the central bank, by way of many things, by way of remittances by Indians abroad, by way of exports, they are being kept as reserves in India.
Right.
So that our import obligations and other obligations, the debt discharge obligations, etc. of government of India, they are being met out from these reserves. So in 2004, there was a feeling that we have comfortable reserves. Therefore, the liberalized scheme of remittances, outward remittances, it was brought into the play, right? Initially, the limit was only $25,000. Now, since 2015, LRS has been expanded to reach $250,000.
Right.
That means anybody in a particular financial year, subject to the terms and conditions in the Foreign Exchange Management Current Account Rules 2000, they can freely remit up to $250,000 to anybody within the framework of the rules.
Right. And there are specific activities in respect of which this money can be remitted. There are things, for example, which you may not be permitted to do through the remittance of these funds. But it's interesting that you mentioned that it was only in 2004 that the various stakeholders in the governance of the country were able to take a call that we are in a position where largely our foreign exchange reserves are in a comfortable position. We will not be we will not be faced with a situation where we are having to scurry around to find those foreign exchange reserves. And so therefore, in light of the other growths and developments in our economy, we might as well allow our resident individuals to have the ability to remit funds under this LRS scheme. It's also interesting that you mentioned that over a period of 10, 11 years, the amount or the quantum of the amount that you were able to remit outside has grown significantly from what was once only $25,000 a year to now what is $250,000. And if I'm not mistaken, it applies on an individual basis and on a per financial year basis, which means that if you're a family of 4 persons, then each of those persons within a financial year have the ability to remit up to $250,000 under the LRS. So now, what is it about credit card transactions that caught the government's scanner? And why was it that the government felt the need to intervene or step in with respect to the change that it has just made?
Yeah. So what happened in May 2023, this month only, was an interplay between 2 provisions. One was, as I told, that foreign exchange management current account rules of 2000, which has been in the being because of Section 5 and Section 46 of the FEMA 99, right? And because of that, we have this LRS. LRS came into being in order to give effect to what is there in the current account transaction rules. Under the current account transaction rules, there are 3 schedules: Schedule 1, Schedule 2, and Schedule 3. Schedule 1 is the prohibited items, what cannot be remitted. For example, purchase of lottery tickets, or purchase of tickets for sweepstakes, right? Or foreign commissions abroad which will be invested in JB, etc., right? They are a no, we cannot do that. So the Schedule 2 is where the government's approval is necessary. Okay, cultural tours, right? So you have to have the approval of the Ministry of Culture and the Ministry of Education, right? So there are many items within Schedule 2 which can only be, or rather all items in Schedule 2 which can done only with the approval of Government of India or the ministries of the Government of India. Schedule 3, it is referred to in Rule 5 of the Foreign Exchange Management current account rules, right? The rule would specifically say that the Schedule 3 will be governed in terms of the directions there in the schedule, right? And once you go to the schedule, it says that RBI will give approval of these following items in excess of rupees 250 or dollars 250,000 per annum, right? And then the catch is here that there is another rule called Rule 7.
Right.
And Rule 7 would say that Rule 5 would not apply in respect of international credit card transactions with respect to meetings of somebody who is outside India, meeting expenses outside India.
Right.
So, Rule 7 in May 2023, Rule 7 was omitted from the Foreign Exchange Management Current Account Rules of 2000.
What was the impact of that?
The impact is that became part of the LRS, right? That became part of the LRS. Now, once it became part of the LRS, it got into that threshold of $250,000, right? Number 1. And number 2, now comes the repercussion in the direct taxes. In the Finance Act of 2023, there has been some change in the particular provision with regard to TCS on the foreign remittances. So once the international credit card transactions came within LRS, the particular provision in the Income Tax Act, that is 206C1G, it covered the international credit card transactions. So far, international credit card transactions was not considered as part of the LRS.
Right.
Now it became part of the LRS. Therefore, 206.1G, it covered the international credit card transactions, and that opened up the possibility of TCS in respect of those transactions. That is why all this hullabaloo.
All right, sir. So I think that's a lot of things which have happened. Let me try and put it down in chronological order, and then you please feel free to intervene if you think I've got the order wrong. But just to take it on a step-by-step basis, prior to May 2023, in fact, let's even go before that, as of the Finance Act of 2022 being passed, there was a provision with respect to TCS on transactions under the LRS scheme, and the TCS that was applicable at the time was 5%.
Correct.
But it did cover transactions under the LRS scheme. Now, let's keep that aside for a moment. We have the current account transaction rules of 2000 as amended in 2015. There's a Rule 5 which talks about taking approval from the Reserve Bank of India in respect of some transactions. There was a Rule 7 in that which said that credit card transactions in respect of transactions that take place outside of India, those will fall outside of the purview of Rule 5 and read with Schedule 3. So this was the status quo prior to what has happened in 2023. In 2023, we first had the Finance Bill, which has since become the Finance Act. And what the Finance Act has done is it has changed the TCS rate from 5% to 20% in respect of transactions that take place under the LRS route. Then in May 2023, the current account transaction rules were amended simply to omit Rule 7. As a result of that omission, credit card transactions have now also come under the LRS route. And because they have come under the LRS route, they now attract the 20% TCS rate under subsection 1G of section 206C of the Act. Is that a broad overview of what is happening?
Right. Subject to many qualifications and many concessions which have come of late.
Right. So we'll talk about some of those clarifications as well. My first question in respect of this is, what was the need for the government, from its perspective, to want to make this change in terms of taking credit card transactions outside the exclusion of Rule 5? And that's one part of what I want to talk about. The other part of what I want to talk about is the 20% rate, but we'll come to that in just a second. What about the first aspect of removing credit card transactions from the exclusion in Rule 5? What was the reason for that?
The reason which has been put out by government is impeccable. We cannot refute the reasons for what has been put out. LRS as a form has been popular over a period of time. And the remittances under the LRS, it has also increased over a period of time. It has been stated that in 2021, the remittances under LRS was a little over $12 billion. It went up to $19 billion in 21-22. And it was like $24 billion in 22-23. $24 billion. Can you imagine that? And out of this $24 billion of LRS, more than 50% was said to be travel related. So that has been the quantum of the LRS being remitted outside India, all precious foreign exchange being remitted out of India. That is one part. And the second part is, government says that in few cases or in some cases, because of the international credit card transactions, which is not being accounted as part of the LRS, people have exceeded the limits of LRS. That means the limit of LRS being $250,000 per annum per person. In some cases, the normal LRS routes, whatever have been remitted in that person, include that with the international credit card transactions, then it has exceeded $250,000.
Right.
If the government is citing these instances, cannot say the justification of not including, even it could be an isolated instance, but this has propelled the changes of bringing in the LRS payments or rather the international credit card transactions in the LRS basket, right?
Right. So it seems like there were a few things happening. So one was that you have a prescribed limit of $250,000 per financial year per individual under the LRS. On account of these credit card transactions, presumably the government and the RBI had managed to collect sufficient data to justify that there were some, at least in the case of some, but maybe more than just some individuals, there were people who were frequently exceeding the $250,000 limit.
Correct.
And in essence, they were able to scuttle the prescribed rule, and there was a need to stop that. Was there any other way in which the government or the RBI, for that matter, could have stopped it? For instance, could they have mandated a limit on, an upper limit or a ceiling on credit card transaction, the amounts of transactions that are made, or the quantum of transactions that are made on credit card limits, such that it would not exceed $250,000 a year?
See, there could be many innovative ways in which the things could have been managed. Simply because the LRS remittance, it goes through under a form called A2 form, right? If you look at the A2 form, there are something like 18 main classifications and 142 sub-classifications. It starts off with the capital account transactions, including investments in property, investment in shares, participation in joint ventures or wholly owned subsidiaries, right? Purchase of intangibles like IP and all those things are there. Then you have many transactions. You have transactions with regard to transport, with regard to financial services, with regard to personal recreational services. There are some 18 main classifications and 142 sub-classifications, right? So any of the limit, it could have been imposed with regard to the authorized dealers, with regard to that particular sub bracket, meaning thereby, suppose donation is there, we can say, the government could have said that donations will not exceed suppose $10,000 a year or something like that. But LRS has been played around by the policymakers on an overall basis. Capital account transactions, some capital account transactions in the LRS, including the current account transactions with regard to your, whether you are supporting your family abroad, etc., right? Your tour expenses with regard to your education, medical needs, etc. They're all clubbed together, and there is a flat single, headline kind of thing, that 250,000 overall. That is your limit, right? There is no sub-classifications. One could have used all those, filters with regard to containing the remittance portion with regard to those sub-classified items, right? But what has been done also can be reasonably expected of the government, because LRS at the end of the day is a drain on government's resources. While nobody can deny the citizen's right to repatriate as long as there is a need for him to repatriate the funds, but the excessive draining of the foreign exchange reserves through LRS, it would have been it is tried to be contained through the mechanism of the TCS, which is, I think, it's a fair option for the government to exercise.
So why do you call it a drain on the government's resources? The reason I ask is because one way that people would think of it is that the money which is being repatriated outside is ultimately the money that the individual has to his or her account.
Correct.
And it is this money which is going out. The government comes in, or the banks come in at the time of conversion of foreign exchange. So if it's only the foreign exchange which is being converted, I suppose one could think of foreign exchange as being the reserve or the resources of the government. But is there any other reason why we think of repatriation or remittances under the LRS as being a drain on government resources?
No, it's a drain on the resources because, the need for foreign exchange, as I told, for the purposes of discharging the sovereign debts which the government of India has with regard to many items, including imports. They are there, right? They are the pressing needs of the government to have a fair level of foreign exchange reserves, right? So the way the TCS has been formed, the whole, the gamut of TCS has been formed, is to look at the remittances and to say that these remittances, once they suffer a tax, so we can also track those payments outside India. There are, Aditya, there are two ways in which a foreign remittance can be mapped and it can be recorded. One is, as you know, under the LRS route, right, in which we get, the Income Tax Department also gets the data in the SFT, the Specified Financial Transactions data, if it exceeds a particular level, right. The other one is under the 15CA, Form 15CA route, in which the bankers also give us some data with regard to 15CA, CB and CC report. So there are ways of collating those data, but data compilation is one thing. Preserving the reserves and prudent in the management of the foreign exchange is quite another, right? What has been tried, looking at the whole position, is that getting a tax or TCS on the foreign exchange remittances under the LRS. It was not a very old idea. It's an idea which generated only in 2000, right? In 2020. Only in 2020 that Government of India thought that the TCS outgoing from India, it should have a component of TDS attached to it. That is why
the transactions under the LRS should have a component of TCS attached.
Absolutely. So that is the reason as to why we have woken up way too late with regard to TCS on the LRS.
So why do you say late? Why do you say that we've woken up way too late? Is it because that had this particular route been identified earlier? When I say route, I mean had one applied their mind to taking out TCS from these LRS transactions, say years in the past, there could have been a lot more tax collection, a lot healthier tax collection. Is that why you say it's woken up way too late?
More than the quantum of TCS, which government would have lost, because the TCS on the LRS came only in 2020. Right. One must see the inequity between the domestic payouts and the foreign exchange payouts. For example, giving an example, when you buy a property in India, you suffer a TDS under 194(1)(a). Right. But if you are buying a property through LRS, and you are paying in installments, right? Less than $7 lakh less than 7 lakh rupees a year, right? Or you manage the payouts in such a manner that there will be no TCS. Then you avoid paying a TCS over there,
right?
So there is an inequity between treatment of payouts under the domestic area for the domestic transactions and one for the transactions which are of international remittances. So more than the quantum, of course, the quantum would have been a consideration. There is inequity between the two streams of remittances.
So it was felt that there was perhaps no collection or deduction of tax at source in respect of international transactions as opposed to domestic transactions, and in order to make that a little more equitable, the government thought it was necessary
this is my interpretation.
Okay.
That there is an equity.
This could have been one of the reasons why.
It could have been one of the reasons. In 2020, when the 206C1G came
inserted, yes.
There are only two items in 206.1G which suffer TCS, right? When in 2000 it came, it said that any purchase of overseas package tour program, right? Overseas tour package, you suffer a TDS, and remittances under LRS, it's right. So these are the two items which will suffer a TDS, but it came in 2020, right? So that said, the bringing into the statute books 206.1G with effect from 2020, it has, to my mind, it has brought some level playing field with regard to administration of TDS and TCS provisions in the Income Tax Act.
Right. Let's now talk about that change in rate. When it was introduced in 2020, when subsection 1G was introduced to section 206C in 2020, the rate at which TCS was to be collected was only 5%. In this current Finance Act of 23, that rate has changed to 20%.
Correct.
So tell us a little bit about the thinking of why this has happened.
Before that, let me bring the one significant change in the construction of 2061G as it was conceptualized in 2020 and what has happened in 2023 Finance Act. One is the first provisor to 206C1G.
Right.
So 2061G first provisor, earlier times it would say in 2020, 21, 22, it would say that there will be no TDS in respect of an amount with a threshold of 7 lakh rupees except for the purposes of overseas tour package.
Correct.
Meaning thereby, overseas tour package will suffer a TDS no matter whatever be the ceiling. There is no threshold.
Right.
Right.
So it could be even 3 lakhs, for example, and you would still suffer a TCS of, at the time, 5%, now 20%.
The amendment in 2023, the first provisor has been redrafted. It says that TCS will be 20% instead of 5%. It is 20% with a ceiling of 7 lakh only with respect to education and medical treatment. So this is the first one was a negative exclusion, and the second was a positive inclusion. Right? Now, only with regard to medical treatment and education, there is a ceiling. There is a threshold 7 lakh. For any other items of remittance under the LRS, there is no threshold. Every remittance will suffer a TDS of 20%. Right? So that is the only change.
That is a significant change, sir. What was the reason for that? I think let's get to that first.
5% to 20. See, to me.
So sorry, sir. Just to be clear, that the change from that negative exclusion language to the now positive inclusion language, which is to say that prior to the Income Tax Act as it currently stands, and prior to the Finance Act 2023, you had the ability to, as long as your LRS payouts were less than 7 lakhs, you would not be subject to the 5% TCS. But now, the 7 lakh threshold itself only applies if that money is being spent in respect of education and or medical treatment.
Correct.
What was the reason for this? This is a fairly significant change. So what is the reason for that change?
I may not be able to tell you the reason behind the change, because the explanatory memorandum of the Finance Act 2023 does not say the compulsion behind changing it to 20%.
Okay.
But on facts, the 20% range, it comes at the highest end in the whole spectrum, or it's one of the highest in the whole spectrum of TDS and TCS.
Right.
Right. In 206, if you look at 206 itself, we have range from 1%, 2.5%, 5%, right? So this 20%, to that end, it's an outlier.
Right.
But there could be some reasons as to why it was 20%. Maybe the extent of the repatriation was such that would have prompted the policymakers to look at 20% as the applicable rate, so that the repatriation is stemmed and the flow also gets a little stunted.
So I'd like to talk about some practical scenarios and some real life examples. But before I get to that, I'm interested to know what is the actual procedure in terms of how the LRS works. What happens? So let's say I, as a resident individual, wants to buy something that is available on a foreign marketplace or offshore. How do I go about doing that? How do the banks come into the picture? This usage of foreign exchange, how does all of that happen? So could you maybe tell us a little bit about that?
Yeah. On the field, what happens is that the buyer of the foreign exchange, for whatever purpose he may be needing it, which are within the kind of classifications which are given in the LRS permission of the RBI, he goes to the bank and asks the amount to be remitted in dollars or in any foreign currency. there is a form called A2 form.
Right.
And A2 form has to be filled in, including the purpose. That's very important. The purpose for which the remittance is to be made. So then the bank does the due diligence, right? What is your your PAN details is a compulsory. You have to give the PAN details, and also your passport, right? The purpose of the remittance, as I told, that is a must. So bank, after doing the due diligence, would remit the money, but will debit your account with the TCS or whatever is there. Not just the amount of remittance, but also the TCS which has been recovered from your account. This is the way it goes on the field.
Right, sir. And now, in terms of a credit card transaction, this happens electronically on a website, or for that matter, through the phone or an app on the phone. The bank doesn't directly come into the picture over there. Is there a way in which the bank is able to nevertheless intervene and ensure that the Indian rupees are being converted into foreign exchange, and a charge is being made for TCS as well?
Even though you are intending to pay for a website or through any other electronic mode, the fact that it can't be a case that your credit card or your debit card is not linked to the payment, whatever you're doing. So once the credit card and the debit card comes into play, then the TCS happens automatically. The bank has to look at the ceiling of 7 lakh rupees if it is for education or for travel, and nothing with respect to any other item in the LRS basket, and will be debiting your account with the TCS.
And how, for example, do the banks, as in the authorized dealers, or for that matter, the government or the RBI, ensure that the credit card is not being used for purposes outside of the LRS scheme? So we in fact, you mentioned a short while back that when you had to go through, for lack of better words, the traditional route of going to the bank, you also had to declare the purpose for which you wanted foreign exchange. How is this monitored through credit card, in the case of credit card transactions?
No, the intent of your remittance, it will be clear to even to the banker. Suppose you are paying for a travel related expense or an entertainment related expense, or for any other purpose, it will be noted from the transaction history and the transaction details.
Right.
So that way, the bank will have some knowledge about the purpose of the remittance, even though it is not through the normal route of filing a A2 and getting your money remitted, right?
Right.
So the TCS on the credit cards, whether it is credit card or a debit card for international transactions, that is quite permissible, even though it is done through other means other than the normal A2 LRS route.
Understood. Let's now talk about those practical examples. The first one that comes to my mind is, today, let's say I travel outside of India. I'm on a tour, holiday, and I do some shopping over there in the foreign country, and I use my credit card for these transactions, the things I purchase when I'm going shopping. What was the position before this new rule? What is the position as it stands today?
There will be three positions. One is, before this amendment, you would not have been visited with a TCS had it been less than 7 lakh rupees.
Right.
Now with the new amendment, the shopping done through international credit cards would suffer a TDS. There will be no threshold, and there will be 20% TCS on there. But on 19th of May 2023, the Ministry of Finance has come out in a Twitter message saying that the TCS with regard to international debit card and credit cards up to 7 lakhs is secured. One does not really know at this point in time whether any international transaction of whatever nature, not just for education or for medical treatment, whether they are included in the government's message for having a threshold limit for the international debit and credit card transactions. So once the message is clear through the subsequent circulars or later on amendment in the Finance Act of next year, then we come to know actually whether the message given by the Minister of Finance with regard to no TCS for international credit card and debit card transactions up to 7 lakhs, whether it is across the board or it is limited only to travel, only for education
and medical treatment.
or medical treatment.
So I actually also saw that press release. It's been uploaded on the Press Information Bureau website for 19th May 2023, as you mentioned. When you were describing this and talking about this, I actually had a question that came to mind. I don't know to what extent it's relevant, but if you had to go about the task of crafting this clarification in legal terms to give it legal effect, what do you think is the approach that should be taken? So you have a provision now in the Income Tax Act which is very clear, and that has the statutory force of Parliament in subsection 1G of section 206C. And you have this omission of Rule 7. Presumably there now has to be some change to the current account transactions rules itself, which sort of brings back certain transactions within that threshold and saves it from the LRS, which will then attract the 20% TCS. Is there any other approach that comes to mind in terms of how it could be done? Certainly, they're not going to amend the Income Tax Act for something like this, or might they?
No. What gives me hope in the further development of this issue is the very message of 19th of May 2023. Remember, in the COVID times, there are some announcement by the Minister of Finance with regard to some relief which was to be given to people who have either died or who have received some money from their employers.
So how would you, since you brought up the clarification of 19 May 2023, and in fact, I've checked the Press Information Bureau website as well, it's been uploaded there as well. How do you think the government will now go about the task of giving legal effect to this clarification? Is it something that's going to require an amendment of the Income Tax Act, which I personally don't think is something that is necessary, or for that matter, something that will be considered? Or is it just a question of now making a further amendment to the current account transaction rules to ensure that credit card transactions that fall within this threshold of 7 lakhs, we still have to see how the government is going to describe it and what exact terms they're going to use. But is it just a question of amending the current account transaction rules to say that credit card transactions that are within 7 lakh rupees will not attract Rule 5 and therefore the provisions of 206C 1G?
In my reckoning, both changes that we made in the current account rules and also in the Income Tax Act.
Oh, I see.
Right. I can see a parallel in this particular issue with the COVID time messages and discussions which happened during that time and emanated from Ministry of Finance. In COVID times, you understand that the COVID relief in form of ex gratia to the people who have died or some medical support from employers or others. Under the current law, those are being taxed. Those could have the potential of being taxed. So the Ministry of Finance announced that they will be tax-free. They will be exempt, right? And this was by way of an announcement, similar to announcement which had been made in respect of 194C, 206C 1G. It was followed up with an amendment later on. Right? So the announcement first, then there will be a circular, or there may not be a circular, but the final points of law which is emerging from out of that particular message, they are to be converted to legal language so that the taxpayers also have that assurance that our international debit card and credit card transactions has a ceiling limit of 7 lakh rupees, and the purpose which the government will decide, whether the government intends it only for the purpose of education and medical treatment, or it is across the board. So this has to be converted to a legal form in a later date.
Right, sir. And in fact, one thing I forgot to mention is that I understand that this 20% rate is only going to take effect from 1 July 2023.
Absolutely.
So do you think that this clarification, when the necessary legal forms will come into force before 1 July 2023, or is it something that might spill over beyond that?
No, I think this 20% TCS post 1st of July 2023, there will be no rethinking on this one. This is done and dusted.
Right.
I mean, government has already through Parliament decided the TCS rate of 20%, right? And so that would be at this point in time, there is no case before the government that to reconsider the rate or the items which will go, or whether that will be a threshold for remittance of money for other purposes, etc. So once there is a fair bit of deliberations and discussion and clearing of minds, then probably an amendment later on a later date, on a later year maybe, that would see.
Right. Let's now go back to that example that we were talking about of someone who has gone abroad and done shopping and used their credit card. And we spoke of how there were 2 or 3 different scenarios, as in the position that existed prior to the current Income Tax Act, the position that exists as of today, and the position, I suppose, which might exist subject to what clarification the government offers. Now, what about a scenario in which today whilst sitting in India, am purchasing, let's say, books or gadgets from a foreign marketplace, an online marketplace that is headquartered in a foreign jurisdiction, whether it's a laptop, let's say, or books. What was the position that existed prior to the recent change in the current account transaction rules and the position as it exists now?
No, remittance under the LRS, it would cover the direct remittance by the authorized dealers.
Right.
But now that the international debit card and credit cards, they are also to be included in the LRS, and your account would have been linked to your debit card and credit card, or your dynamic conversion debit card or credit card if you're traveling abroad. That would have been necessarily connected to your account in India. And the liability to get your TCS is vests upon the banker or the authorized dealer. So he has to make sure that the transactions of a value in excess of 7 lakhs or without any threshold, if they are in nature of remittances as given in the LRS and the later clarifications, then there has to be a TCS. And the TCS will be imposed by the bank, not by any other agency across India. It doesn't matter, honestly.
Right. So another common activity that certainly people like me engage in is we purchase subscriptions, whether it's on the phone for various apps, or whether it's to use professional software such as PDF editing software, which someone like me as a lawyer will use very frequently. For some of these as well, I'm having to use my credit card, and there's a recurring transaction that takes place. Will there be any change in terms of how that is calculated, or whether that will attract TCS?
As the law stands, there will be a TCS on the amount of remittances, and it is not the foreign supplier who is suffering the TCS. At the intermediate level, the bankers who are remitting, they have the duty to determine and deduct and collect the TCS from you and remit it to the government.
What about a scenario in which you have a family who, and the child in the family has gone abroad to, say, pursue higher studies or a degree of any sort, and the parent is transferring or remitting funds to that child in order that the child can live abroad? Will that particular transaction attract any TCS?
Education and medical treatment up to a level of 7 lakhs, there will be no TCS. Remittance of money not in excess of 7 lakhs. For education and medical treatment, there will be no TCS. Beyond 7 lakhs, there is a liability to TCS.
Just to take off from that example, let's say it's a case of a child who's working abroad somewhere, and on Diwali, for example, let's say an Indian parent sends some money to the child who's living abroad. Is that a transaction that might attract TCS? So this is not in the case of education or medical treatment. So is this something which might attract TCS?
See, this is part of the whole LRS basket, right? You can transfer foreign exchange to your close relatives under Section 277 of the Companies Act, as defined in Section 277 of the Companies Act. This is quite permissible. But as the law stands with regard to TCS, this item will be covered for a liability of TCS on the remittance.
Understood. The other thing that I find very fascinating about credit cards or debit cards, but mostly credit cards, is that a lot of these cards have some sort of a points or reward system involved. So the more you use the card, you get reward points, and if you use it often enough, these rewards and points will actually translate into something tangible. So for example, a flight ticket, you might be able to fund just on the basis of miles that you've accumulated or reward points that you've accumulated. I have a series of questions actually in this regard. Firstly, without even coming into the question of TCS, does the accumulation of points or rewards or miles or whatever you call it, does that have any sort of taxable element involved?
Yes. What happens in the tax law and the tax legislation is that this is tackled in mostly in two ways. One is, suppose you are doing, you are running a business, and in course of the business, you get a rebate or a discount, or you get some benefit or some perquisite while pursuing your business, right? Benefit in the form of allowing your family and you to travel to Singapore for a 3-day holiday over there, right? So these money value of those transactions, they are taxed under Section 28, Roman 4. But in case of somebody, if he is not in business, he is getting these kind of rebates and discounts and loyalty points, etc., which are have the potential of getting converted to money, right? How do you treat those? There are two ways of looking at it. One is the discount part. You get a discount. There will be no taxable event happening with regard to a discount. Right? You have, normally, suppose you would have paid 100 rupees for a particular goods. Because of your loyalty card, you are paying 80 rupees. There will be no taxable event happening. But if you get cash back is money in your hands. That becomes taxable under Section 56 to 10. Right. 56 to 10, it becomes taxable. So up to a level of 50,000 rupees, it will be tax deductible. But beyond, above 50,000, it becomes income from other sources in your hands.
And the whole amount, irrespective of the fact, even if it's 51,000, all of it is included. So 50,000 is sort of a cliff.
Yeah.
Now, in the days that followed the initial omission of Rule 7 in the current account transaction rules, and when people were able to wrap their heads around what the effect of this would be in terms of the higher TCS rate, there was a suggestion, primarily on social media, that people might start making a return to cash transactions. And a lot of people sort of decried this because it seemed to be a move away from the larger sort of push towards digital transactions that we've seen in India over the last several years. Do you share the sentiment that people might start moving away from cashless transactions towards cash transactions? And where do you think all of that will lead?
It's not going to happen that people start, ferrying cash across the borders. Because these are governed by pretty stringent rules.
Right.
Under the customs relevant rules, cannot take more than $3,000 in currency notes outside India. And once you exceed that limit, there are various checks at the embarkation and disembarkation points. So international traveler, if he's carrying foreign exchange, he has to, have to fill in and submit a currency declaration form. And the currency declaration form will tell you how much you are carrying with you. And suppose it is found out that you are carrying excess of the foreign exchange with you, then the whole gamut of processes and actions which will happen. There is a section 113 of the Customs Act. There will be a confiscation, and there will be penalty, and there will be various and adjudication also on those items which are in excess of your permissible amounts which you can carry. So there are consequences, and I don't think that this particular amendment will prompt and push people to move to a more cash kind of transaction habit.
So, do you have any final thoughts on this subject in terms of whether it's the change in rule, whether it's the clarification that came thereafter, whether it's the economic impact of this rule? Any final words on this particular subject?
Yeah, I have a couple of suggestions to make. One is that the liability of the authorized dealers to conduct due diligence, that has to be more rigorously pursued.
Right.
So that any unfruitful or infructuous or unnecessary or fictitious remittance does not happen. They are the first responders. Other enforcement agencies come much later. The authorized dealers, the banks, they are the first responders with regard to remittance of money. They have the greatest responsibility of looking at the remittance, right? So this is one. And the second part, I would say that logically there was no reason as to why LRS payments should not be suffering any TCS. Insofar as I told, there is inequity between treatment of domestic payments and receipts and treatment of international payments and receipts. So TCS on LRS, I think it was a step which should have happened much earlier than 2020. And the third part is that we need to look at the submissions which are being received by the enforcement agencies. For example, the income tax. There is a lot of scope in improving our design of 15CA, 15CB and 15CC forms.
Right.
And 15CA, it would say specifically that LRS payments are not to be included over in the 15CA. That means a large part of the remittance, a large part of the foreign exchange remittance is not being captured through our own templates in the forms which we have designed. So there is some room to include, there is some room for improvement of the design of the forms and the submission of the data from both from the banks and from the taxpayers.
So before we close, can we just take a few minutes to talk about the taxpayer? I'm just trying to understand in terms of how they will arrange their finances or their tax outgoes in respect of this policy. So you have the TCS, which they are required to now pay, which will be a markup on the purchase price of whatever it is that they're purchasing. This TCS which they are paying is something which can be set off against their tax liabilities and their...
Yes. So what happens here is that, there is a provision in 206C, 206(4), which would say that the TCS, what has been paid on behalf of somebody, in somebody's name, it will be to his credit, and due credit as per prescribed rules will be given to him.
Right.
And the prescribed rule is Rule 37I. And that 37I would lead you to the procedure in which the TCS credit will be given to you.
Right.
While you are framing your return of income or paying your taxes. And then comes 2091D. 209 is a section which tells you about advance tax. And 2091D would say that once somebody has suffered a TDS or a TCS, that amount will be given to his credit at the at the time of computation of his advance tax. So
Okay.
it will be considered. So the TCS, what is being paid on behalf of somebody, will be part of his total tax paid, including,
Right.
as I told, advance tax, etc. So it's not that it's an over and above
Understood.
the tax, right? It's not a superfluous tax, but it is part of his total tax payments.
So just to summarize, the TCS is something which can be set off not only at the time of reconciling the final tax liability of the taxpayer. So if it turns out that he has already, on account of TCS, paid more tax than he is required to pay, then he gets he'll
refund.
be entitled to a
Yeah.
refund. Moreover, it is also something that can be set off on a periodical basis against the advance tax liability that they have to pay each quarter.
Absolutely.
So there are two ways of sort of managing cash flows.
Absolutely.
So TCS, when at the time of making these purchases, particularly around the conversion of Indian rupees to foreign exchange, there's perhaps some element of a service involved over here. So there might be some GST. Is the TCS also calculated? Does it include the GST as well when computing the TCS amount?
No, 206C, it says that whatever is being paid by the buyer, whatever is being paid by the buyer, or whatever has been billed to the buyer, if the bill would include the amount of GST, then there will be a TCS both on the GST and the bill value. So TCS will happen because there is no clarification. There was a clarification with regard to section 194S or
TDS.
194R,
Right.
that the GST will not be part of the
TDS.
of the TDS. But there is no clarification with regard to 206(1)G, right? So, to my mind, the language of 206(1)G would say that at the time of payment or at the time of debiting his account, and when you are debiting his account, you are also taking into account the GST component also.
Correct.
So, in the absence of any clarification or any beneficial circular with this regard, and being on the side of prudence, I would say that TCS will happen on the GST component as well.
Right, sir. Thank you so much, sir, for your time. I think this has been a very enlightening and fascinating discussion.
Thank you.
I'll be very interested to see how this particular issue develops over the next few weeks and months, and I think a lot of people would be interested as well. Thank you, sir.
Thanks so much.
That's been another episode of the Private Office Podcast. Thank you so much for listening. Thank you so much for watching. If you're enjoying these episodes, please tell your friends about this. Please give us a 5-star rating and don't forget to subscribe to the Private Office Podcast. Goodbye. Thank you.